banking crises don't just break banks, they rebuild the power map. Most people think a banking crisis is just about money disappearing, stock prices dropping, and scary headlines on the news. But a real banking crisis is deeper than that. It's a reset button. It changes who controls credit, who controls businesses, who controls housing, and who controls your future options. And the scariest part is, these power shifts don't happen loudly. They happen quietly, through emergency rules, forced sales, bailouts, and fear. So today, I'm going to show you exactly how banking crises quietly reset power, who wins during the chaos, who loses, and how smart people protect themselves before the reset happens. Stay until the end, because once you see what a crisis really does, you'll stop thinking of it like a bank problem and start seeing it like a power transfer. Let's start with the basics. A banking crisis happens when trust breaks. Banks don't operate like safes full of cash. They operate like systems of confidence. They take deposits, lend money, invest, and keep only a fraction available. So, as long as people trust the bank, everything works smoothly. But when that trust breaks, people rush to withdraw. Businesses pull funds, investors panic, and suddenly the bank doesn't have enough liquid money to meet demand. That's when the machine starts shaking. Now, here's the first way a banking crisis resets power. It concentrates banking even more. During normal times, you have choices: big banks, small banks, credit unions, local lenders. But during a crisis, fear pushes people toward the biggest names. People think, small banks feel risky. I want the biggest bank possible. So money flows upward. Small banks lose deposits. Large banks gain deposits. And weaker banks get bought out or disappear. That means fewer banks control more of the money system. And when fewer banks control more money, they control more credit, more decisions, and more influence. Its pattern interrupts. Crises don't just kill banks, they create banking giants. Now, the second way crises reset power, credit gets tightened. When banks get scared, they stop lending, or they make it much harder to borrow. That means fewer loans for regular people, fewer mortgages, fewer small business loans, higher interest rates, stricter approvals. And when credit tightens, opportunity shrinks. People who needed a loan to start a business can't get it. People who wanted to buy a home can't qualify, so the economy slows. But the powerful benefit, because they don't need loans as much, they already have cash, assets, and access. So credit tightening acts like a gate. It blocks regular people while elites still walk through. Now, the third way. Distressed assets get sold cheap. During crises, people and businesses panic. They sell stocks at the worst time. They sell property under pressure. They sell businesses to survive. And when sellers are desperate, buyers get discounts. Who has cash in a crisis? The prepared big investors, institutions, the wealthy. So crises become buying seasons for the people who already have resources. That means ownership shifts, more homes become investment properties, more businesses get bought by larger corporations, more local wealth becomes corporate wealth. This is one of the biggest power transfers in modern history, and most people don't even notice it happening. Now, here comes the cliffhanger. Why do governments rescue banks? Because the economy runs on banking. If banks fail, money flow stops, payroll stops, credit stops, spending stops. The whole system can freeze. So governments and central banks step in. They do emergency lending. They guarantee deposits. They create support programs. They stabilize markets. And sometimes that support is necessary because a total collapse would be disastrous for everyone. But here's the uncomfortable truth. The way rescues are designed often protects the system first, not the people first. And when the system is protected first, the people who own the system benefit most. Now, the fourth way crises reset power. Rule changes. In emergencies, rules shift fast. Banks get new protections. Regulators gain new power. Deposit limits can change. Lending rules tighten. New compliance requirements show up. And while these rules may be meant to prevent future disasters, they also reshape the landscape. Big banks have teams of lawyers and compliance staff. They adapt easily. Small banks struggle with the cost. Small businesses struggle with paperwork. Regular people struggle with complexity. So rule changes often increase barriers. And barriers protect the biggest players. That's how power becomes concentrated quietly through safety. Pattern interrupt. The system calls it stability, but it often creates control. Now, the fifth way, a banking crisis increases government influence because when private banks are unstable, central banks become the backstop. They provide emergency support. They set policy. They decide interest rates. They decide liquidity. That means central authorities gain more control over money flow. And even if they mean well, the result is still the same. Power becomes more centralized during crisis, and once power centralizes, it rarely goes fully back. Now, the sixth way, regular people lose negotiating power. During stable times, workers can demand better pay. Small businesses can bargain. Buyers can shop around. But during crisis, fear increases. People accept worse deals. Workers accept lower wages. Businesses accept harsh loan terms. Borrowers accept higher interest. This is why crises reshape society, not because people suddenly become weak, but because survival changes behavior, and the side with more cash and patience gains more control. Now, let's talk about the seventh way. Trust moves from people to systems. In a crisis, people learn a painful lesson. Your money is not just your money. Your money depends on access. It depends on trust. It depends on systems staying stable. And once that reality hits, society changes. People become more dependent on institutions because they feel like they need protection. And dependence creates power for the institutions that provide it. That's why crises can reshape culture, not just markets. Now, here's the final piece. Banking crises change the future. After a crisis, people become more careful. Some stop investing. Some stop starting businesses. Some stop taking risks. That lowers innovation. It lowers growth, and it creates a generation that moves slower. Meanwhile, the people who were strong during the crisis buy assets cheap, rebuild faster, and grow wealth bigger than before. That's why crises create long-term inequality. They don't just harm the present, they shape the next decade. So, what can you do? First, don't rely on one single bank. Spread risk when possible. Second, keep an emergency fund, because access matters. Third, avoid toxic debt, because debt makes you fragile. Fourth, keep building skills, because skills keep income flowing. Fifth, invest with a long-term plan, because panic selling is how wealth transfers away from you. And sixth, stay calm, because the calm person in a crisis doesn't just survive, they position. Here's the real lesson. A banking crisis is not just a banking event. It's a power event. It decides who controls credit, who owns assets, who survives, and who gets stronger. The people who win aren't always the smartest. They're the most prepared. They understand that money systems are built on trust, and when trust breaks, the rules shift. So don't wait until the next crisis to get serious. Learn now, prepare now, build stability now. Because when the reset happens, you want to be the person watching calmly, not the person reacting in panic. If you want more money truth, financial history, and simple wealth lessons that actually make you smarter, subscribe to Cashfree World and hit like so YouTube pushes this to more people who need it. And comment below. Do you think the next crisis will strengthen big banks or finally weaken them?